Hey, it's Tom here and welcome back to the channel. So in this video, I'm going to be doing a quick reaction to a Charlie Munger interview from 2016. Now, this interview is actually one that was done for the HBO documentary Becoming Warren Buffett. If you haven't seen that documentary before, I'm pretty sure it's available on YouTube and I'll leave it linked down in the description below. It's very good if you're a Warren Buffett fan like myself. And there's sort of clips from this Charlie Munger interview kind of dotted throughout that documentary. But just in the last week or so, they've actually released the full 35-minute interview with Charlie, including obviously many of the sections that didn't make the full documentary. And I just want to kind of watch and react to a couple of the clips that I found most interesting from this interview. I'm not going to go through the full 35 minutes because that would be a ridiculously long YouTube video. But if you're interested in checking out the full interview, again, I will leave that link down in the description below. But for now, let's get into it, and I hope you enjoy.
Well, he was an old Graneman Newman follower, and he'd made a lot of money buying thinly traded securities that were incredibly cheap statistically. And with small amounts of money, which is what he's working with, he could find enough of those to earn pretty high returns on capital year after year after year. Now, occasionally, the market would give him a big security to buy instead of an obscure. And the first one I remember of that kind was American Express, when the salad oil swindle pretty well clobbered that stock for a while. Warren went around, did a lot of research, and decided that it was a minor blip. The market was wrong and he was right. So he bought a big A-rated security and made a lot of money. But mostly he was buying more obscure securities that were incredibly cheap.
Now that is actually something I've made a video on. Just the video right before this was around how Warren Buffett would invest smaller sums of money, and one of his key advantages was being able to get into these weird little underfollowed kind of companies that were trading very, very cheaply, and that was really his main strategy in the early days, like Munger said. And later in this interview, he actually mentioned that one of the main reasons that Warren Buffett ended up kind of transitioning strategies to buying into higher quality companies, but maybe paying up a little more for them, was really the fact that that strategy didn't scale very well. You could really only invest small amounts of money into them, into these little, underfollowed companies. And at a certain point, Warren Buffett was starting to invest so much money that he really had to focus on the larger, more closely followed companies that he could really buy into and own a big chunk of them and then hold for a long period of time. So like Munger said, American Express during the salad oil crisis was one of the first examples of that. Later in this interview, Charlie Munger actually talks about See's Candy as well. Basically what happened with American Express and the salad oil crisis was essentially American Express were kind of storing all of these drums of salad oil, salad dressing, I don't quite know, in one of their warehouses, and they were actually, I believe, lending an individual money against that big bulk, salad oil commodity. And when the people actually came to get that salad oil or inspect kind of what's in these big drums, he found that quite a big chunk of those drums was actually filled with seawater, and this guy was kind of ripping off American Express, which clearly cost them a lot of money, tanked the stock, and it provided an opportunity for Warren Buffett to buy in, because he was famously going down to restaurants and talking to people that were accepting American Express cards and traveler's checks as they were back in the day. And it seemed kind of unchanged from that kind of aspect of the business. So the business is still intact, going through sort of a short-term event and pretty good buying opportunity. So very much like an events-based investment that clearly has worked very well, and Warren Buffett still owns American Express today. I'll put up a picture of the stock price here. It's done ridiculously well since he has owned it. I think this chart probably won't even go back to the point where he bought into the stock, but it's done incredibly, incredibly well.
He was just like me. He didn't improve much at all for decades. We were pretty good, but not really good. And then he really started working at it and working with somebody who was a world champion. And he is really quite good now. Whereas I have stayed the same.
That's a funny story. I've never played bridge. Maybe I should. A lot of these famous investors seem to be into playing bridge. But earlier in this interview, Charlie Munger also mentioned that Warren Buffett is incredibly competitive, and he really only competes in sports or card games or investing even as long as he thinks that he can do it to sort of the best of his abilities. So at a certain point there, he was really into playing golf, got reasonably good at playing golf, and then got to the point where his body just wasn't up to the task of continuing to play golf at that level, and he just stopped playing altogether. But he's still able to play bridge, and he's still able to invest at an extremely high level. So let's hope that continues for a few more years to come for Warren.
Well, we found out what had happened because we were on the board. And that's another example of a mistake that finally worked out pretty well. We never should have bought into Salomon. It was too much trouble. It was too much danger. It was too much involvement. And Warren would have probably made more, even though the investment finally worked out well. It caused a lot of agony, and Warren would have made more money some other way better. So it was another mistake that worked out well. But the crisis, once we were on the board, the company could have gone under. It was a very serious, exciting crisis with crucial meetings. And if Nick Brady, the Secretary of the Treasury, hadn't relented on a key point, Salomon might have gone under. And he went with Warren because he trusted him, and it saved Salomon. It shows how having a good reputation is really helpful in life. The interesting thing about that is Nick Brady's family had owned stock in Berkshire when it was a textile company. And he, when he was at the Harvard Business School, determined it was a lousy business, and he had his branch of the family sell out. The other branch of the family stayed, and the guy got to like Warren when he came on the board, and he was kind of a stubborn New Englander. And he held all his shares in this lousy, failing business. And of course, he became enormously rich. Whereas Nick Brady, who made the correct decision to get out of a lousy business, watched his relative who knew less and hadn't gone to business school and so on, made this great fortune. Life is full of little ironies like that one. I don't think it bothers Nick Brady. He's a pretty mature fellow. But it was one of those crazy quirks of life.
It's pretty crazy how things work out like that sometimes. I think when Warren Buffett was first buying into Berkshire Hathaway, he was buying at $9 or $10 a share, something like that. And we all know today the Berkshire Hathaway share price is like $400,000. So big mistake from Nick Brady, but I'm glad to see he didn't hold that mistake against Warren Buffett when the Salomon Brothers scandal sort of happened. And goes to show, I think, a couple of things. Firstly, the power of having a really good reputation. I won't go into the full details of what happened at Salomon. I'll save that for this documentary if you haven't seen the full documentary before, because it gets into quite a bit of detail. But shows the power of having a very good reputation, because Warren Buffett was sort of given an extra life in a lot of ways to kind of clean up that company. And it also shows that the mistakes with Buffett and with a lot of investors have often happened when they've sort of strayed from their typical strategy. So this reminds me a little bit of Bill Ackman and some of the mistakes he's made with trying to short Herbalife and so on. Warren Buffett is not typically one to get on the boards of companies. He's done in the past, but really doesn't do it that much anymore. Salomon was one where he did get on the board. Berkshire in the early days was one where he obviously became the chairman and kind of ran the thing. But typically he's a very sort of passive, hands-off investor. He likes to put money to work. Generally, he's buying into businesses with good management teams and so on that he can sort of just let run their business, and it allows him to free up a lot more sort of brain power to work on other things once he's made that investment, and it's just kind of a less stressful approach to investment in general. So interesting to see mistakes getting probably more and more common when investors kind of veer off and do things that they maybe wouldn't typically do?
Well, if you start with a bunch of lousy businesses, which is what we started with, but we're going to wring a fair amount of cash out of those businesses. So basically, we started out with cash and ended up buying a bunch of businesses, including insurance companies, and drove Berkshire without really issuing much stock to anybody, from virtually nothing into hundreds of billions of dollars of market cap. Nobody else has a record like that. There's some great conglomerates: General Electric, United Technologies, Honeywell. But nobody has a record like that. If you're in a big bureaucracy, it can't change. It's just too hard. So you may say, well, I'd like to operate that way with no overhead and just a few people at headquarters and quick decisions that are good. But they're locked into a procedure like the Army or Navy with lots of meetings and people, and they just can't get to where we are from where they are. And they know that, and so they just shrug their shoulders. If some people can do way better than I do by that method, why, God bless them. I don't envy them because I can't follow them.
One of the great secrets to Berkshire Hathaway, kind of like I touched on in the previous clip, is that they have a very decentralized model. So in other words, they leave the businesses that they acquire to sort of lead their own lives. They have very good managers in place and good incentive structures for each of those managers to kind of keep them on task. Munger famously said, show me the incentive and I'll show you the result. So they're very aware that the incentive structures have to be set up correctly. But Berkshire is an incredibly extreme example of that sort of decentralized structure. So Berkshire, across all of their businesses, has about 400,000 employees. I'll put that exact number up on the screen here, but I think it's in that ballpark roughly. And I'll now put a photo up after that of the Berkshire Hathaway team at headquarters. And you'll notice it's about 20 people, I think, roughly. So to have an organization that employs 400,000 at all their subsidiaries, but only has 20 at head office, and most of the capital allocation decisions are really only made by Warren, and now you could argue sort of Ted and Todd and Ajit Jain and some others are sort of in that mix as well. But really most of the big decisions are being made by Buffett with a bit of consultation from his sort of sidekicks. It makes them very nimble, and it makes them able to make decisions very quickly, and that makes them a pretty attractive company to sell a business to as well. So that again has been sort of a key competitive advantage for Berkshire, is that if someone is looking to sell their private business and they really care about the employees continuing to, have a job for a long time after that business is sold, and they really don't want to mess around with having to have, shareholder votes and all this sort of stuff, they can come to Berkshire and typically get an answer within probably 5 or 10 minutes of whether Buffett is interested in buying into that company. Okay, let's do one last clip from Charlie because this is one of my favorites and something I've been trying to implement personally. So I'm knowing the big idea, so let's have a look.
Well, I've always had the idea that if you pretty much knew all the obvious things you should know in pretty much all the disciplines, and use that knowledge routinely, and didn't go crazy or irrational or go into anger or resentment or a lot, that it would work very well. And so naturally I've operated that way all my life. It was my way of getting ahead. I didn't get ahead by specializing. I got ahead by knowing the big ideas in all the disciplines. And that works if you're a wide-ranging investor, like me or Warren. It's not the way for most people to get ahead. And so we were very lucky to have the outcomes we did. I don't think either of us deserves huge credit for what happened. We're in the right place with the right family values, the right temperaments. And I'm sure we had some favorable breaks. But yes, I was lucky in that my grandfather Munger really believed down to the soles of his feet that rationality was a moral duty. That's just the way he was put together. And so it was very easy for me to pick up that idea.
There's a very famous Munger quote again. I know I'm plugging out a lot of Munger quotes and Buffett quotes and so on here, but he often says, to a man with a hammer, every problem looks like a nail, and that is exactly what Charlie Munger is getting at here. When you're investing, you often have to be a very good problem solver, but you have to solve many different types of problems. Not every problem that you look at will be a nail, and therefore you can't just use a hammer with every single problem that you come across. And if you've ever read like a Poor Charlie's Almanac or Damn Right, which I think is by Janet Lowe, which is a great book on Charlie Munger as well, he talks about this idea of having several mental models in your sort of mental toolbox in order to solve these many different problems. So Munger is a very wide-ranging reader and investor. So he's studied sort of what he calls the big ideas. So the big ideas of physics, of biology, of the economies of scale in business. He's studied many of the successful businesses of the past century and of several centuries, and he's also studied many different aspects of psychology, and he's able to sort of merge all of these things together in order to figure out how a business sort of fits into the world, identify whether it has some sort of competitive advantage that really is enduring. So, for example, like a Berkshire Hathaway, obviously, but they have many different subsidiaries and so on, but identifying things like Costco, which he saw had a phenomenal advantage in terms of their ability to supply goods to customers at very, very low prices, and they had a model that could scale for a long time. And he's now been involved in Costco. I think he's owned it for north of 20 years now, or coming up around 20 years, and he's also been on the board of Costco in the past as well. I'm not entirely sure if he still is, but being able to have this wide-ranging sort of mental toolbox has been a very useful approach for Charlie Munger. Okay, so that's my reaction to a few Charlie Munger clips from this full interview from the Becoming Warren Buffett HBO documentary. Like I say, highly recommend checking out the documentary itself if you haven't seen that before. I've watched that a few times now, and it's always pretty enjoyable. Again, I will leave the full Charlie Munger interview that just came out in the last week or so linked down in the description below. But that's it for me for this one. Do hope you enjoyed the video, and I will see you in the next one. Cheers.